Last week I read a statistic that the average mutual fund in Canada turns over their holdings at 110%. That means that the holding period is less than 1 year for any of their investments. So clearly we are moving more towards speculation than we are investing. Investing means buying stocks for fundamental reasons and holding them for long periods of time because you're compensated for that. And this week I wanted to talk about the cost of speculation and particularly what it costs for an individual. The average individual has a $25,000 account, and that statistic is pretty consistent between the United States and Canada. And assuming 250 trading days a year, which is about the number of working days that you have in a year, and you pay $10 for each buy and $10 for each sell, and you trade only once per day. So that's $20 a day times 250 days is $5,000 that you're going to incur in costs. We haven't even figured out whether you're right on your stock selection, but you've incurred $5,000 worth of costs on a $25,000 account. That's 20%. That means that you have to make 20% rate of return just to pay the commissions. So it's small wonder that banks and brokers make it very simple for you to trade, because what other business can you have individuals handing over 20% of their money over a course of a year and not even blinking at it? They're cashing that in. Now, is that the only cost that you incur as an individual? No. In fact, there's a bid-offer spread. When you buy a stock, you buy it at the offer, and when you sell it, it's a bid. And the difference is actually a cost to you, so you couldn't instantly get out at the same price that you bought it for. So if you look at a stock, something like Tim Hortons, the bid offer is only a nickel, so 5 cents. But now let's look at how that 5 cents adds up over the entire year. So 5 cents a day times 250 trading days, and you're looking at $25,000 in trading, that adds up to almost $10,000 worth of costs you have to cover. So let's add the numbers together. 10,000 plus 5,000 means that you're going to pay $15,000 in transaction costs out of your $25,000 account simply by trading once per day. So that means you have to make 60% a year. Now, are you that right? Is your information that good? Even if you trade as little as once per month, you eliminate the gain that an investor makes in the market. And what do I mean by a gain in the market? An investor gets to participate in the growth of the economy. So if you look at the US economy, $11 trillion, and it grows by, say, 3%, that's about $330 billion of wealth that's being created every single year that investors get to participate in. Or if you look at it long periods of time, that amounts to about 7–8% in terms of rates of return for equity markets. But you eliminate that gain, that simple gain that accrues to you every single year by trading too often. Because then you have to be right. You don't get the benefit of that tailwind. So for investors, it's really important to be exactly that. Be an investor. Invest in strong companies for long periods of time and resist the urge to trade. Just because it's simple and it looks cheap doesn't mean it's the right decision.
You